I'm Teresa Matic with the Investing News Network. Here with me today is John Kaiser from Kaiser Research. John, thank you for joining me.
Teresa, great for having me on here.
So you speak a lot about four main themes for junior miners, and one of them is the need for higher risk exploration to reignite the sector with a really great discovery. What kind of exploration does it take to make that sort of discovery?
It requires an exploration program with a target that has a world-class discovery potential. And that is what has historically bailed us out of these deep bear markets. There was Hemlo discovered in 1981, which was the horrible recession that followed after gold's rise to $850. There was Eskay Creek in 89 to 90. There was Ekati in 92, 93. There was Voisey's Bay in 95. 96. All of these injected capital into the system, had spawned a Me Too activity amongst the other juniors, and it breathed life back in the system. That doesn't seem to be happening right now, and I'm keeping my eye out, looking for companies doing innovative, out-of-the-box exploration that has the potential to deliver a jaw-dropping surprise.
And what companies do you see doing that sort of exploration?
Well, one that I've just recommended is a company called Tsodilo Resources, which I own, and they have been in Botswana for the last 10 years, and they have a deal with First Quantum on their property Xaudum, where they've developed the theory that this is an extension of the Central African copper belt, which is the richest concentration of high-grade copper deposits in the world. And First Quantum spent $14 million building a case, developing targets, which they have now started drilling. And if they hit what we're looking for, here's a little junior with only 30 million shares issued, a 30% carried interest, trading at $1 or so, and that stock could go double-digit if, in fact, they have 30% of a field of Kamoa-like deposits.
Okay, well, that's certainly a great endorsement, but what would you say to investors who are maybe still worried, put off by the risk of the junior sector?
Well, you look for hedged type situations, and in this case, Tsodilo also has acquired from the government, Botswana government tender, a pipe, a diamond pipe that De Beers had found 30 years ago and discarded as too low grade and not interesting enough. But it's somewhat similar to the AK6 pipe, which Lucara acquired and turned into the Karo mine, which now produces 100 carat plus diamonds worth $30–40 million each. And they think that this is a similar pipe, and they're doing systematic exploration in a way that's never been done before. So you have a plodding feasibility demonstration story in the background to which the market is assigning the main value. So you get the upside on this discovery for free. So one looks for a hedge situation like that, a free lunch. You look for exploration free lunches where if they don't find it, nothing happens. But if they do find it, it goes way up. And then you have another story which is going to just sort of motor it up gradually over time.
Okay, and you've also mentioned with these sorts of stories, it's really important to look for a strong geological argument as well as all that potential. Why is that?
Well, the geological context becomes the basis for speculating that, in fact, there is a major discovery. And in the case of the Xaudum project, what First Quantum has done is it's created a huge geochemical database. It's drilled stratigraphic holes. None of these are intended to actually find anything. It's there to confirm that this is indeed the geology that has the potential to host world-class deposits. So managements now need to work really hard in putting together their data, creating these graphics, these cartoons, even sequences showing what they think they have, what the model, genetic model is that's behind it, and what evidence they have marshaled that this target has a very good chance of delivering. This is now what I look for. If somebody's just drilling an X on the map, forget it, because that gives me no reason to hope that in fact the brains of the geologists have put something together. And in this type of market, this is one which separates the wheat from the chaff. The serious geologists who know what they're doing, they're now looking for putting together these serious plays, presenting them to the audience, attracting the risk capital needed to test them. The other guys, the pretend guys, they can't do that. They can't persuade any audience that they have anything meaningful. And I think there's a structural change in this sector. My topic today is going to be fast and slow trains out of this bear market trough. Most of the big themes are now slow trains, and individual companies are going to do well, but there's not going to be this knock-on effect where other companies start going up because, say, gold is going up. It's going to be happening because individual companies benefit, and if gold does develop a modest uptrend, you're not going to see all these junky pretend companies rise with the tide. This has changed, I think permanently changed. We're going to be dealing with a much smaller universe of resource juniors in the next decade.
Well, that certainly sounds hopeful. Shifting a little bit more to the broader market, you follow the metal trends a lot as well, and you made some really interesting points about China and their moves to cut emissions, maybe not be as lax on that front. What does that mean for some of the metals?
Well, China, since 1980, has been an absolute plague as far as many metals are concerned, because China has come from producing next to nothing in a lot of these metals to becoming the dominant supplier of these metals. And China has cheated in doing this. They adopted a policy of, even if they have environmental rules, they're not enforced. They basically became decide we will be the toilet for the world's emissions. But now that they are successful and you have an emerging middle class, and they've discovered that their food chain is contaminated because they irrigate all their crops from river waters, which happen to be the toilet for every mine and every refinery and every factory. And of course the air is so polluted that the wealthy people are leaving China with their children because they don't want their children to die at age 50. Beijing, the Communist Party in Beijing, has realized our biggest threat to our power is a massive insurrection, because people are extremely unhappy about the dirtiness of this great rising China. And Xi Jinping has launched an anti-corruption crackdown, which is the first wave in reasserting the central command control over all these oligarchs and that which have evolved. And then the next stage is the environmental crackdown, which has to be done at the local level. So he's literally cleaning out all the obstacles on the path down to the level where it needs to be enforced, and then they can start cracking down. And all these little mom and pop operations, they're going to be shut down. These refineries and that take the dirty concentrates, they're going to be shut down. So you're going to see zinc supply come down from China. And the market doesn't believe this happens. They think China has an invincible ability to keep ramping up zinc supply, which is why they're reluctant to jump into the zinc juniors right now, even though it's clear that Western mines are depleting at a greater rate than new mines are coming on stream.
Okay, and talking about zinc, is there a particular zinc play you're interested in?
Well, the one that I've been recommending for the past few years is In Zinc Mining, which has the West Desert project, and it has a valuation of only like $8 million, and they published a PEA that indicated a $250 million NPV with a capex not that much different from that, and a good internal rate of return. But the market doesn't want to back anything until it sees a true zinc breakout, because zinc has been the eternal just around the corner boom that's going to happen. Zinc price needs to go through $1.20, and then everybody will rush into these things. So it's a classic bottom fishing. You buy this, the company's treading water, it doesn't want to finance at 10, 12 cents. Now's a chance to just put in a position that over the next 2 to 3 years, in my view, has a 1,000% upside potential when zinc breaks out, and then there's a scramble. Oh boy. And what's going to make it a panic, a mania, is the realization that Chinese zinc supply is in decline.
Wow, okay. And finally, John, what's the last stock you bought and why?
The last stock I bought is Uravan Minerals, which has also been a multi-year recommendation, and they are an undercover exploration company. They're looking for uranium deposits in the Athabasca Basin at the unconformity, using a geochemical technique at surface where they look for lead isotopes and at certain ratios, and these are decay products of uranium deposits. They drilled a target last year, it came up empty, the stock cratered 70% down to 3-4 cents. Now the other target, they've worked it up. Cameco will be drilling 2 holes. Now it's cry wolf. Nobody's bidding the stock up or anything. And this time they are truly excited about the target. And if it hits, not only do they have something on a potential MacArthur River scale, but they have a method they can apply elsewhere in the basin in deeper parts where you have virtually nothing geochemically at surface and where your geophysical surveys are too fuzzy to come up with too much.
Okay, that's interesting.
And I own that one too.
Okay, great. Thanks for that, John. Thanks for joining me today.
Thank you, Teresa.
I'm Teresa Matic with the Investing News Network.